Mortgage rates are going to be the key to the housing market going into next year. Today, we're going to dig into our mortgage rate forecast for 2025, and I think my prediction at the end of this video is going to surprise you. Hey everyone, it's Dave, and today I'm going to walk you through what could happen with mortgage rates in the next year. We're going to talk about what the Fed is going to do, the risk of inflation, risk of recession, how the bond markets will react, and we are going to arrive at the most likely path for mortgage rates over the next year. And after this video, I think you're all going to consider yourselves mortgage rate experts. But before we jump in, I do want to be candid that predicting mortgage rates is really, really hard. There are people who spend their whole lives doing this and still get it wrong. So if you're watching any other videos and there are people acting like there's some certainty as to what's going to happen, there isn't. It's complex and constantly changing. But we can determine the most likely path for rates, and that's exactly what we're going to do today. So first things first, let's just talk about where mortgage rates are today. As of this recording, we are at November 21st. Mortgage rates right now are just a little bit above 7%, which is pretty similar to where it's been for most of 2024. We did see some positive movement down to almost 6% in August, September, but they have shot back up in recent months. And by the end of this video, like I said, once you understand everything about mortgage rates, all of that will make a lot of sense to you. But let's dig into that. Why have mortgage rates shot back up? Why are they the way they are? What variables go into mortgage rates in the first place? The quick and easy answer is that there are two primary factors that we need to consider. The first is the yield on 10-year US Treasuries. I'll explain what that means in just a minute. And secondly, it's something that we call the spread, which is basically the difference between those 10-year Treasury yields and mortgage rates. And I know these are not the most exciting topics in the world, but this is how mortgage rates work, so we're going to talk about them. And I think it's important to note here right now that I did not say the Fed. The Fed is involved. We'll talk about them in a minute, but they are not one of the two primary variables that impact mortgage rates. So if you want to understand where mortgage rates are going, listen up about these two variables. All right, so the first variable was US Treasuries. This is also known as a bond. If you're not familiar with the concept, it's basically like this. The US government needs money to spend. They ask investors to lend them money and they pay them interest in return. And the amount of interest that the return that the investor generates from lending the government money is known as the yield. So I'm going to pull up this chart here, and there are three lines here. First, just look at two. Just look at the orange one, which is mortgage rates, the average mortgage rate. The second one, the blue line, is the 10-year Treasury yield. Now, if you look closely, do you notice something here? I hope you can see that these two lines are almost perfectly correlated. So when one goes up, the other goes up. When one goes down, the other goes down. These two things are very, very closely related. I'll also call out now the third line, the purple line, which is the federal funds rate. That is the interest rate that the Fed controls. And you'll see that yields and mortgage rates are somewhat correlated. They kind of move in the same direction, but the real relationship, the real love story here is between Treasury yield and mortgage rates. So of our two big variables, that was the first thing, yields. Now let's move to our second thing, which is what I said is called the spread. This is basically the difference between yields, the thing we were just talking about, and mortgage rates. And even though these two lines move together, it doesn't mean that this distance between those two lines is always the same. It's actually always changing. In normal times, mortgage rates are roughly 2% higher than bond yields. So if, for example, the yield on a 10-year US Treasury was 3%, you would expect mortgage rates to be about 5% in that environment. But this can change, and it does change all the time, because the spread is what's known as a quote-unquote risk premium. This can get complicated. I won't get fully into it, but here's the main point. Remember when I said that treasuries are essentially investors lending money to the government? Well, those same investors, these are like hedge funds, pension funds, they often also invest in mortgages. And when they're deciding where to put their money, they have to consider risk and return. And generally speaking, US Treasuries are considered the safest asset in the world. And that's great for the US government because it means that they can pay the lowest interest rate. For mortgage issuers, they are still relatively safe in this sort of whole universe of investments, but mortgages are riskier than US Treasuries. And so lenders charge a higher interest rate to mortgage borrowers, and that's the spread. That difference, that increase in interest rate that they charge to compensate for risk, is basically what's known as the spread. So that's the spread, and it moves all the time. But basically what you should know is that when there is more risk, when there is a higher appetite for risk, the spread will be lower. And when investors have a lower appetite for risk, the spread will be higher. And this is actually what's happened over the last couple of years. We've seen the spread shoot up above 3%. It's now down a little bit, about 2.5%, but it's still well above the normal of 2%. Just to reiterate, those are the two things we really need to look at, is the yield on 10-year treasuries and the spread. And just to sort of hammer home this idea, we have 7% interest rates today. How did we get here? Well, as of this morning, bond yield on 10-year US Treasury is 4.5%. The spread is at 2.5%. And bam, we have 7% mortgage rates. But explaining this part is the easy part, because the real question in forecasting mortgage rates is the direction of bond yields and the spread. We don't know where they're going. We, of course, know where they are today, but trying to predict where they're going in the future is complicated. Bond yields in particular are highly influenced by the Fed. So like I said, they are not perfectly correlated, but they are influenced by the Federal Reserve. They're also influenced by what's going on in the stock market, and they are highly influenced by inflation and the risk of recession. Bond investors are always looking at these four things and other things to determine how much they want to invest in bonds, in mortgages, or other things. So these are the big variables that impact bond yields. And basically what you need to know is what I said before, which is that treasuries are seen as a safe haven investment for investors. And when you look at yields, it's basically an indicator of investor sentiment regarding the economy. If investors are upbeat about the economy, they generally want higher risk, higher reward investments than treasuries. And this tendency drives treasury prices lower and yields higher. And this is kind of what's happening right now. If you're wondering why yields and mortgage rates have gone up in the last couple of months, it's because investors are generally feeling better about the economy than they were just a couple of months ago. Investors who, on the other hand, who are wary about the economy might step back a bit from riskier investments and instead put their money into treasuries. And that actually lower yields. And so interest rates, inflation, and economic growth are all among the biggest factors that you need to follow to understand the direction of treasury yields. So given this information, where will bond yields go in 2025? Well, we know that the Fed is probably going to keep lowering rates, and that's going to put downward pressure on yields. But since the Trump re-election, the fears of recession have declined, which pushes up rates. So those are kind of counteracting each other. Remember, rates go up when investor sentiment is good, and it is relatively good right now. The other factor that we need to think about next year is inflation. It has come down and it's relatively close to the Fed's target, but many investors are fearful that tariffs could cause a one-time jump in inflation. We don't know if those tariffs are going to happen, what they will look like, but there is fear that that's going to happen and reignite inflation. And so that is another thing that could be putting upward pressure on bond yields in the next year. So when you factor all these things together, if you want to know what Wall Street people think are going to happen to bond yields, you could take a look at this chart. It shows them peaking somewhere around now and then slowly starting to decline over the course of the first half of 2025 before flattening out and achieving some sort of equilibrium at around 3.6%. Personally, I think this trajectory makes sense, that yields will probably start to come down a little bit. And there's definitely going to be a lot of volatility, especially in the next couple months until we see the economic policies that Trump's going to prioritize, what shape those policies are going to take, when and how they're implemented, and all of that. So I think the trajectory makes sense, but I actually think yields might stay a little bit higher than this forecast here and probably will stay most towards the high threes. So instead of equilibrium maybe being at 3.6, maybe something closer to 3.8, but that's just my estimation. And there is a lot of uncertainty right now. If Wall Street is correct, which is unclear, but this is what traders think is going to happen, and spreads stay consistent, this means we're going to see rates come down to the low sixes by the end of next year. And generally, I think this is pretty close. I think spreads will stay above their long-term average because there's just a lot of uncertainty right now. And so I think that risk premium is going to stay relatively high. In the first half of 2025, my guess is that we'll see an average interest rate somewhere between 6.5% and 7%. And then things will get better from an affordability perspective in the second half of the year, and rates will probably come to somewhere between 6 and 6.5. So let's call it average second half of next year, 6.25%. Is it possible that something else will happen? Of course. What I'm telling you is what I think is the most likely scenario. If, in fact, there is a recession, we'll probably see rates fall further, and we could see mortgage rates in the high fives. That's certainly possible, but I don't think it's the most likely case. And to be clear, we may see some days where rates are in the fives next year. I'm not saying it's not going to happen at all. I'm talking more about the average because these things can be volatile and they might drop into the fives briefly, but I don't think they're going to sit in the fives for any period of time in 2025. On the other hand, could rates go up? They sure could. If inflation reignites because of tariffs or really because of anything else, rates could push back up to the mid sevens or even higher. It's possible, but again, I don't think it's the most likely scenario. So in summary, as I said before, I think we'll see rates start to trend down in the coming months, but not as much as many people expect. So what does this mean for the housing market? Check back soon as I will be releasing my price forecast in the next couple of days. Until then, let me know what you think will happen with mortgage rates in the comments below. Thanks for watching.